Have you ever heard someone say the secret to investing is buying low and selling high? What if I told you that if you're automating your investing, you're already doing that without predicting anything, without watching a single chart, and without even trying? In the last video, I told you to automate your investing before your lifestyle expands and eats the money first. Today, I want to prove why that one habit is secretly one of the smartest strategies in investing. Using real market data, real numbers, and 3 example investors whose results are completely real. Meet Maya, David, and Elena. All 3 invested the exact same amount of money, $66,000, into the S&P 500 over the exact same 10 years, January 2015 through December 2025. Same money, same market, same decade. The only thing different about each of them was how they put that money in. Maya has a superpower. She invests $500 every single month, $66,000 in total across the 10 years. But she times every purchase perfectly. Every single month, she buys at the exact lowest price of that month, not close to the bottom. The exact bottom. Every time, for 132 months in a row, without a single mistake. David invests the same $500 every month, the same $66,000 in total. On the same day, every single month, that $500 leaves his account and buys shares of the S&P 500. He does not check the price first. He does not wait for a dip. He does not know if the market is up or down that day, and he does not care. This strategy, investing a fixed amount of money on a fixed schedule, no matter what the market is doing, has a name. It's called dollar cost averaging. And by the end of this video, you'll see why it might be the most powerful investing habit most people have never heard explained properly. Last but not least, Elena invests the same $66,000 too, but not a little at a time. She had the entire amount available at once, so on day 1 in January 2015, she invested all $66,000 in one shot. Then she did absolutely nothing for 10 years. Same $66,000, same market, 3 completely different strategies, perfect timing, steady monthly investing, and 1 early lump sum. So after 10 years of the real S&P 500, real prices, real crashes, real recoveries, here's where all 3 of them landed. Maya, with her impossible perfect timing, ended up with $147,656. David, who never watched the market once, ended up with $142,709. And Elena, who invested her lump sum on day 1 and then simply left it alone for 10 years, ended up with $219,439. Look at those numbers again. Maya and David are almost identical, under 4% apart, but Elena is more than 50% ahead of both of them. 2 very different stories are hiding in those 3 numbers, so let's take them one at a time. First, Maya and David. Let that sink in. Maya did something no human has ever actually done, perfectly timing the market. David did something anyone can do in about 5 minutes by setting up an automatic transfer. And the difference between them after 10 full years was under 4%. Here's why David's boring strategy quietly comes this close to Maya's impossible strategy. Look at October 2015. The S&P was trading around $1,900. David's $500 bought him about a quarter of a share. Now look at November 2025. The S&P was trading near $6,900. That same $500 bought less than a tenth of a share. Same amount of money, very different number of shares. When the price is low, David automatically buys more. When the price is high, he automatically buys less. Nobody told him to do that. The math just did it for him. Stretch that across 10 years, and here's what happens. If you simply average the S&P's price across all 132 months, treating every month the same, the average price would be around $3,600 a share. But because David was always buying with a fixed dollar amount instead of a fixed number of shares, his actual average cost per share came out to about $3,166, nearly 12% lower, automatically, without watching a single chart. And this is exactly why it's called dollar cost averaging. By investing the same dollar amount every month, David automatically averaged down his cost per share over time. So what does averaging down actually mean? Here's the key. Your average cost per share isn't the simple average of the prices. It's weighted by how many shares you bought at each price. And since David spends the same $500 every month, he automatically buys more shares when prices are low. Picture just 2 months. In a month when the market sits at $50 a share, his $500 buys 10 shares. The next month, the price doubles to $100, and that same $500 buys only 5. So he now owns 10 cheap shares, but only 5 expensive ones, twice as many of the cheap ones. And that's the whole trick. When you average his cost, the $50 price counts twice as much as the $100 price, because he owns twice as many shares at that price. So his average cost per share isn't $75, the halfway point between the two prices. It's about 67, pulled down toward the cheaper end. The low prices carry more weight simply because his fixed $500 bought more shares there. He never decided to buy the dip. The fixed dollar rule did it for him, automatically. That's the entire secret behind how he got so close to Maya. Maya doesn't exist. Nobody buys at the exact bottom, every single month, for 10 years straight. But David didn't need to. He never opened a stock chart. He never lost sleep over a red month. He just let the same $500 leave his account on the same day, every month. And he still ended up within 4% of a strategy that is mathematically impossible to execute. And this isn't a fluke of our 10 years either. Charles Schwab ran a similar test over 20 years with 5 hypothetical investors, one with perfect timing, one who dollar cost averaged every month, one with the worst possible timing every year, and one who never invested at all and stayed in cash. The perfect timer won, sure, but the monthly investor came in a close second. The only investor who really lost was the one who stayed in cash and never got in at all. Now let's talk about Elena, because her 50% lead is a completely different story from Maya and David's near tie. So what happened? It wasn't skill. Elena didn't predict anything, and she certainly didn't outthink Maya's impossible timing. What Elena had was time, and time is the one ingredient compounding needs to work its magic. Her entire $66,000 was invested in compounding for 10 full years. David's money, on the other hand, was still trickling in a little at a time, some of it not arriving until year 9 or year 10, so those later dollars barely had any time to compound at all. And this lines up with what the real research shows too. Vanguard studied decades of market history across the US, UK, and Australian markets, and found that investing a lump sum immediately beat spreading it out over time roughly 2/3 of the time. Elena's result wasn't luck, it's the typical outcome with lump sum investing. Let's be honest about what this means. If you ever come into a lump sum of money, an inheritance, a bonus, a business sale, getting it invested early matters enormously. There's no version of this video where I tell you otherwise. Time in the market is the single biggest lever there is, bigger than any clever strategy. But here's what also matters. Most people are not Elena. Most people don't start with $66,000 sitting in a bank account. Most people build wealth the way David did, a little at a time from a paycheck, month after month. And David's numbers just proved something important. You don't need Elena's head start to succeed. You don't need Maya's impossible timing either. You just need to start, stay consistent, and let time do what it already did for all 3 of them. The only real mistake in this entire video would have been a 4th investor, the one who kept waiting for the right time to start and never actually did. If you're building wealth from a paycheck, not a windfall, you are not behind. You're doing exactly what the data says works. The only thing that can take that away from you now is waiting. Now, one important note before we wrap up. Everything in this video is for education only. It is not financial advice. Historically, over the long run, the market has trended upward. But past performance is never a guarantee of future results. So do your own research and talk to a qualified financial professional before making any investment decisions. With that said, before you close this video, ask yourself one question. 10 years from today, do you want to look back the way David did? Or do you want today to be the day you kept waiting for? And if you want more simple animated explanations about money, investing, debt, taxes, and financial freedom, subscribe to the channel. Next time, we'll look at an account so powerful the IRS gave it a triple tax break. And most people are still using it wrong.